So imagine a toy company, right? And you're watching their gross profit margin shrink by 0.5%.
Right.
At the exact same time, their legacy seasonal outdoor division is just, it's bleeding double digits. Completely out of step with what modern retail demands.
Yeah, on paper, those two metrics alone should send institutional investors running for the exits.
Exactly, running for the exits. But, and this is the crazy part, this same company is sitting on a $60 million cash war chest.
Oh, wow.
Yeah. And they just hit a decade-high record in international shipping volume. Oh, and their earnings per share. It just multiplied by 8 compared to this exact time last year.
It's a fascinating dichotomy.
Welcome to this Talk Tickers edition of The Deep Dive. I'm so glad you're joining us today because our mission today is simple. We are taking the Q2 2026 earnings call transcript for Jakks Pacific, that's ticker JAK, and we are translating all that Wall Street jargon into plain, actionable language just for you.
Because there's a lot of noise out there.
So much noise. And we're going to cut right through it. We're keeping this brisk. We're data forward. And yeah, we've got some opinions. We're giving you the absolute most important takeaways.
And really, the broader context here is that Jakks Pacific is standing at this, well, it's a very specific, fascinating structural crossroads right now.
Right.
On one side, they're battling these systemic changes in retail logistics, things that are just fundamentally shifting how goods move. But on the other side, they are surfing these massive, unprecedented global pop culture waves.
Okay, let's unpack this. Because to really understand how they are navigating that crossroads, we have to look at the hard data, the headline numbers.
Let's do it.
So the Q2 figures from the transcript. Net sales hit $139.2 million for the quarter.
Which is solid.
It's a 17% year-over-year increase. And if you zoom out to the first half of the year, sales reached $245.9 million.
Right. And CFO John L. Kimball specifically pointed out that this is their highest first-half total since 2023.
But the top line is, it's only a fraction of the story here. The bottom line is where the Mac gets genuinely aggressive.
It really does.
Adjusted earnings per share EPS, it rocketed to 25 cents for the quarter, up from just 3 cents in the same period last year.
That's a massive jump.
Right. Revenue grew 17%,
yeah,
but the EPS effectively multiplied by 8.
And, when you see that kind of disproportionate acceleration between the top and bottom lines, what you're really witnessing is operational leverage.
In its purest form.
Exactly. It means they've covered their fixed costs, the rent, corporate salaries, those base expenses, so effectively that every incremental dollar of revenue just flows straight to profit.
And here is the discrepancy that immediately caught my eye and why we really wanted to do this deep dive for you today. The efficiency actually wasn't pristine.
No, it was.
Their gross margin dipped. It went down to 32.3% from 32.8%.
Which normally would be a red flag.
Huge red flag. In traditional retail analysis, gross margin is everything. It's the absolute benchmark of pricing power, right?
Yeah.
So it tells you the raw difference between what it costs to make the plastic toy and what you sell it for.
Right.
So normally, if management admits their profit margin percentage shrank, the stock takes a hit. But Kimball and CEO Stephen Berman, they were framing this as a strategic victory. So why? How is a shrinking margin a victory?
Well, what's fascinating here is that it requires a total paradigm shift in how we evaluate profitability. Management is not sweating this tiny percentage drop because they're optimizing for margin dollars, not margin percentages.
Okay, wait. Break that down for us.
Sure. If a company obsesses over maintaining, say, a strict 40% gross margin, they have to artificially inflate their retail prices.
Right.
But in an inflationary environment, the consumer is stretched thin. High prices create friction at the register, so unit volume plummets. Kimball's strategy is that by accepting a slightly lower margin on each individual item, they reduce that friction. And that significantly increases the velocity of sales.
Okay, let me use a plain language analogy here, just so we're all on the same page. It's basically like choosing between making a 50% profit on a $10 lemonade stand.
Right.
Or a 30% profit on a $100 lemonade stand.
Exactly.
Your percentage looks worse on the big stand, but you want the actual cash. You can't pay your engineers with percentages.
No, you pay them with cash. And they brought in over $80 million in gross margin dollars in the first half.
That's real money. But I have to push back here.
Go ahead.
Is that actually sustainable? Sacrificing margin for volume works great until your underlying costs spike. If costs rise again, like resin or freight, doesn't a macro shock just wipe out their bottom line?
It's a classic vulnerability of the volume game, absolutely.
Yeah.
But to see if they can weather it, you have to look at their adjusted EBITDA. Earnings before interest, taxes, depreciation, and amortization.
The actual operational discipline.
Exactly. Their trailing 12-month adjusted EBITDA hit a very healthy $37.8 million.
Wow.
Yeah. And their operating loss for this notoriously slow second quarter, it shrank to just $142,000, down from almost a $3 million loss last year.
That is lean. So they brought their overhead down to basically break even during their quietest season.
Proving that the cash strategy is working so far, they're not wasting those margin dollars on bloated overhead.
All right, so these numbers don't happen in a vacuum. To understand how they got so much cash, we have to look at the story behind the numbers. Like, what products are actually flying off the digital and physical shelves right now?
And the transcript points to some massive success in specific divisions.
Yeah, North America sales jumped 20% in Q2. But the international figures are what blew my mind.
Right. First half international sales hit $53 million.
Which they noted is the highest in over a decade.
Hitting a 10-year high in a mature industry isn't a fluke. It shows their new localized infrastructure strategy is working.
And when you look at the pop culture tailwinds driving this, I mean, I have to geek out over the specifics in the action play and disguise categories.
It's a fascinating mix.
It really is. CEO Stephen Berman credited the Super Mario Brothers property. And get this, they drove more sales for the second movie than they did for the first film.
Which totally counters conventional Hollywood licensing logic.
All right. Usually, the sequel sees diminishing returns from merchandise.
But here, retail buyers were conservative on the first movie because they didn't know if a modern Nintendo movie would work.
Yeah, they remembered the 90s live-action flop.
Exactly. But once the first one made $1 billion, the risk was gone. Retailers bought way more upfront for the sequel.
Makes perfect sense.
Yeah.
We also saw traditional powerhouses like Toy Story 5 doing great. But then there's this highly specific property they mentioned, K-pop Demon Hunters costumes.
Yes. That specific line item is so revealing.
It's so niche. But it's this cross-pollination of massive subcultures, right? It shows they aren't just relying on 50-year-old IP. They are pulling trends straight from TikTok and turning them into physical garments in months.
It's basically fast fashion applied to the costume industry.
Yeah. Oh, and can't forget the dolls and role-play division. It jumped 12% in Q2, and Disney's Frozen is still expanding.
Despite 0 new movies out right now.
Exactly. It's just evergreen momentum, which ties back to that sub-$10 price point they're targeting. It's an impulse buy for parents.
Now, beyond the toys themselves, there was a massive supply chain victory buried in the transcript. The tariff refund.
Yes, the non-operating income boost. Break down this tariff victory for us, because it sounds like accounting magic.
Well, years ago, the U.S. put aggressive tariffs on Asian imports. Obviously terrible for the toy industry. But following a Supreme Court ruling regarding how those duties were collected...
JK has actually fought it and won.
Well, they applied for the refunds based on the legal clarification. And they got a $6.8 million non-operating income boost.
Just pure cash injected back into the balance sheet.
Exactly. Plus, it let them revalue their on-hand inventory without those heavy tariff-carrying costs.
That's huge. But there was another supply chain shift that isn't a one-off. It's a permanent change. Over 75% of their first half shipments were FOB.
Free on board.
Right. Let's translate that Wall Street jargon. What does FOB actually mean for the company?
So normally a toy company pays to make the toy, ship it across the ocean, warehouse it, and truck it to Walmart. It ties up tons of cash and carries massive risk if freight rates spike.
Right, which we've seen happen constantly.
But under FOB, the second that container is loaded onto the ship in Asia, the buyer, like Walmart or Target, assumes all responsibility.
Wait, all of it?
Yes. They pay the ocean freight, they handle customs, they warehouse it. It significantly reduces JK's risk and carrying costs.
Okay, but Walmart isn't a charity. They have to be demanding a huge wholesale discount for taking on that massive headache.
They do, but because Walmart operates at such a massive scale, their shipping costs are way lower than JK's would be. So the discount is actually a win-win.
Ah, an arbitrage of scale. That is brilliant. But look, we have to talk about the structural drag, the bearish element in this transcript.
The outdoor seasonal business.
Yeah. It dropped 12% in Q2, down 17% year to date.
It's a glaring weak spot.
And wait, CEO Stephen Berman actually said retailers are abandoning these bulky items because they don't fit the, quote, low-cost home delivery model.
He was very blunt about it.
I mean, are they just waving the white flag on ball pits and plastic activity tables?
It sounds bad, but management isn't ignoring this. They recognize it as a permanent structural headwind. It all comes down to dimensional weight.
Dim weight, which basically means e-commerce shipping charges you for the cubic volume of the box, not just the actual weight.
Exactly. If you ship a giant box containing a hollow plastic slide, you're paying to ship air. The math destroys the retailer's margin, so they refuse to stock it.
So what's the fix?
Re-engineering. Management is actively redesigning packaging and the products themselves to shrink box sizes, flat packing them.
Like IKEA-fying the toy industry.
Exactly like that. But making new steel molds for injection plastics takes serious time and CapEx. It's a multi-year fix.
Well, fixing those bulky boxes requires long-term planning, which leads directly into what management is promising investors for the future. Let's talk management guidance, looking to 2027.
And they have a massive roadmap here.
Yeah, major theatrical releases for one. Sonic the Hedgehog 3 and Disney Frozen 3 are both coming in 2027.
Providing a very predictable revenue baseline.
But here's where it gets really interesting. They aren't just relying on kids. They're aggressively pivoting into the kidult segment.
Adults buying toys for themselves.
Exactly. They're going hard into anime, manga, and VTube merchandise for fall 2027.
Now, just to clarify for you listening, there's no revenue expected from this in 2026, but it is a massive shift.
Yeah, VTube virtual YouTubers. These are digital entertainers. It's a huge subculture, and those fans have disposable income. They're heavily targeting this segment with The Simpsons, Nintendo, and Sonic.
Because the margin profile on a premium collectible for a 35-year-old is vastly superior to a $10 doll.
But I loved this part of the transcript. Despite this pivot to adults, CEO Berman was so defensive about their traditional kids' toys. He literally said, "There is no crying at JKKS, and there is no crying in the Disney Darling line of products."
It's a great quote. And if we connect this to the bigger picture, management is trying to create basically annuity-like evergreen revenue streams.
Baby dolls pay the rent.
Precisely. They're defending that core segment to build a moat. Plus, they're expanding their international footprint, adding 3 senior sales pros and a South America office, and lowering prices on lower-tier items to increase velocity.
It's a dual-pronged strategy, and they gave us a very specific catalyst to watch for Q4, the giant metal Sonic.
Oh, yes.
A 20-inch tall action figure. It's poised to be a massive holiday item that bridges both the kid market and the adult collector market.
If that sells out and needs replenishment, it's a huge validation of this crossover strategy.
Okay, so we've seen the data, the products, the structural fixes, and the future plans. It is time to render a verdict for you, the investor.
Let's do.
The ultimate talk tickers question. So what does this all mean for you as an investor? Our deep dive verdict on JKKS Q2 2026 is bullish.
Strongly bullish.
Let's rapid fire the actionable takeaways justifying this. Number 1, cash is king.
They finished the quarter with $60.6 million in cash, up from $43.1 million last year.
That is a serious war chest.
Yeah.
Number 2, shareholder returns. The board approved a 25-cent per share dividend.
For the 6th consecutive quarter, they're actively returning capital while we wait for the 2027 initiatives.
Number 3, operational discipline. The operating loss shrank drastically to just $142,000, down from nearly a $3 million loss.
And look, just to put a final polish on this, the risk of lost retail space for bulky goods is absolutely real. E-commerce logistics are unforgiving.
Right.
But JKK's strategic shift toward high-margin FOB shipping, their agility in reclaiming those tariff costs, and the way they're aggressively tapping the kidult and anime markets, all while fiercely defending their core baby doll segment, it just shows a highly adaptable leadership team.
They aren't paralyzed by the friction. They are actively re-engineering around it.
Exactly.
Well, before we wrap, I want to leave you with one final provocative thought, just something to mull over that builds off this transcript but pushes into some uncharted territory.
Fair.
If JKK is investing this heavily into the high-growth kidult, anime, and VTube markets for 2027, will they eventually need to acquire a dedicated premium adult collectible brand? I mean, to truly compete at the highest level.
M&A in the premium space.
Right. Or, zoom out even further, Will the line between a traditional children's toy company and an adult pop culture lifestyle distributor just completely disappear over the next decade?
It's a really compelling thesis. I mean, with $60 million in cash, an acquisition to accelerate that 2027 strategy would make a lot of sense. The evolution from toy maker to a diversified pop culture holding company might be the natural endpoint there.
It's definitely the thread to watch.
Yeah.
Well, we want to thank you for joining this brisk, high-value deep dive today.
Absolutely.
You are now officially armed with the most actionable insights from the JKKS earnings call. Thanks for listening and signing off on this edition of Talk Tickers.